Have you ever wondered what sets technical analysis apart from fundamental analysis? Or if you've ever pondered what makes a scalper different from a day trader? This is the video for you. We'll explore how market players use these strategies to make informed decisions. We'll step inside the minds of traders, from those fixated on charts to others scrutinizing global events, as they navigate the volatile Forex waters. Welcome, future traders. Welcome to part 3 of our free Forex series. Get ready to unravel the mysteries behind these tiny warriors that shape the Forex battlefield. So what exactly is a pip? Prepare to have your mind blown, my friends, because pip is not just an ordinary word. It's an acronym that stands for percentage in point, the ultimate precision tool in trading universe. Now, pips have different personas depending on whether we're dealing with the captivating world of non-yen currency pairs or the enigmatic realm of yen pairs. Let's delve into their fascinating characteristics. Non-yen currency pairs, my curious comrades, are where we witness the full glory of the standard price code. They flaunt 4 or 5 decimal places, revealing the intricate details of price movements. Picture this. In a 4 decimal place code, such as the Euro USD at 1.2345, every digit after the decimal point holds a hidden treasure. It's like peering through a microscope to explore the tiniest fraction of a cent. And within those decimal places lies a whole new world of the fascination. The first digit after the decimal represents cents. The second digit signifies a percentage of a cent. And the last digit unveils tenths of a percentage. Imagine you have $1.23 in your hand. That's the big number before the dot. Now, let's look at the numbers after the dot. We have 45% of a cent and 6/10 of 1%. These numbers show us the smaller parts, the tiny fractions. Think of it like a pizza. The $1.23 is the whole pizza, and the numbers after the dot are the individual slices. The 45% of a cent is like having a small slice, and the 6/10 of 1% is like having an even smaller slice. So when we look at the price 1.23456, we're examining how much something is worth by looking at these slices or fractions of a cent. But here's the good news. You don't have to worry about each tiny slice. Just focus on the big number, $1.23, and understand that the numbers after the dot give us more detailed information. So, instead of thinking about all the numbers, remember to pay attention to the main part, the big number, and think of the smaller numbers as extra details that help us understand the value even better. Now, let's delve into the fascinating world of Forex and explore how these numbers help us navigate the exciting journey of trading. Now, let's shift our focus to the enigmatic yen pairs. Here, the game takes an intriguing twist. Yen pairs possess 2 decimal places, capturing the essence of the Japanese yen's unique currency dynamics. Take for example the USD JPY pair. Let's look at the number 138.606. The main part of the number, 138, represents the value of $1 in terms of Japanese yen. It shows us how much yen we can get for $1. The last digit 6 represents a smaller fraction of the yen's value. It's like a small piece of the puzzle, giving us more specific information about the yen's strength compared to the dollar. So when we see the quote 138.606, we can understand that $1 is worth 138 yen, with an extra detail of 6/10 of a percentage showing the yen's strength. But don't worry about focusing too much on the last digit. The main part, 138, gives us the main idea of the value. So, in simple terms, when we see the USD JPY quote of 138.606, we know that $1 is worth 138 yen, and the last digit adds a small bonus detail about the yen's strength. You see, my future traders, not all currencies dance to the dollars and cents tune we're familiar with, and that's where pips comes to the rescue. They serve as the universal language, translating the diverse denomination into a common ground of precision. Pips are the heroes that bring harmony to the trading world, whether it's Euro cent, the British pound pence, or the Swiss franc rapin. So, the next time you see a pip dancing on your trading platform, remember the power it holds. It's the gateway to unlocking the smallest movements and percentages that can impact your trades. Next, we go to the Forex terms, where we explore the difference between the technical and fundamental analysis and how they shape your trading journey. Let's start with technical analysis, which is favored by 95% of traders. As technical traders, we rely on chart analysis to determine our entry and exit points. We use indicators, support and resistance levels, and other tools to guide our decisions. Our focus is on the charts, and we make trade decisions based on what we observe. If you're trading on smaller time frames, such as daily or less, chances are you're a technical trader relying on chart patterns and indicators for your trading decisions. Now, you might be wondering, how do we know that technical analysis is favored by 95% of traders? Well, let's shed some light on this statistic. The figure comes from various surveys, studies, and observations within the trading community. Online trading forums, social media platforms, and industry reports consistently show that the vast majority of traders employ technical analysis as their primary approach to the markets. Furthermore, many renowned trading educators, experts, and institutions emphasize the significance of technical analysis in developing successful trading strategies. It has become a widely accepted and utilized method among traders worldwide. Additionally, if you dive into the trading books, courses, and educational resources, you'll notice that technical analysis plays a prominent role in equipping traders with the necessary tools and techniques to navigate the markets effectively. So while the exact percentage may vary, it's clear that a substantial majority of traders rely on technical analysis to make informed trading decisions. It has become a cornerstone of trading community and an integral part of countless traders' strategies. Now, let's talk about another type of analysis called fundamental analysis. It's a bit different from technical analysis. Instead of focusing on charts, fundamental traders pay attention to what's happening in the world. They look at news about politics, economies, and other important events that might affect a country's currency. By considering these factors, they try to figure out if a currency will become stronger or weaker. The thing is, fundamental analysis takes more time and patience. Fundamental traders often hold onto their positions for weeks or even months, waiting for the big picture to unfold. While they may glance at charts now and then, their main focus is on the news and events that are happening around the world. Now, let's dive into some real-life examples to understand how fundamental analysis can impact currency trading. Imagine a scenario where a country experiences major political trouble. Let's say country X is going through a heated election season, and the outcome is uncertain. Fundamental traders will closely monitor the news, speeches, and public sentiment surrounding this event. As the election draws closer, the uncertainty creates market volatility. Traders analyzing the fundamental factors will consider how different political parties' policies may affect the country's economy and, consequently, its currency. They might look at factors like proposed tax reforms, trade agreements, or infrastructure plans. By carefully assessing these factors, they can anticipate potential currency movements. Let's consider another example. Suppose country Y, a major oil-producing nation, faces a sudden disruption in its oil supply due to a natural disaster or geopolitical tensions. Fundamental traders will follow the news closely, analyzing the impact of this event on global oil prices and the country's economy. They will assess how this disruption affects the country's balance of trade, inflation rates, and overall economic stability. These factors will influence their trading decisions, as they anticipate how the currency of a country will respond to this situation. Fundamental analysis is not limited to major events alone. It also involves monitoring economic indicators such as gross domestic product growth, inflation rates, employment data, and central bank decisions. Traders watch for surprises or deviations from market expectations, which can create opportunities for them to enter or exit positions based on their fundamental analysis. Remember, fundamental analysis is about understanding the underlying factors that drive a country's economy and subsequently its currency. By staying informed and analyzing the news and events impacting different countries, fundamental traders aim to make informed trading decisions based on the bigger picture. So whether you're inclined towards technical analysis or fundamental analysis, both approaches have their place in the world of trading. It's important to understand their differences and find a strategy that resonates with your trading style and goals. Now, remember, subscribing to our channel is entirely up to you. We believe in empowering you to make your own choices. But if you're driven by desire to make money through trading, if Forex is your passion and success is your goal, then our channel is an invaluable resource filled with knowledge and insights to fuel your journey. So, hit the subscribe button and become part of our Flip community. Don't forget to tap that like button and ring that bell to stay updated with our latest videos. Together, we'll dive into the world of Forex, unlocking opportunities for financial growth and independence. Now, let's talk about trade duration. There are different types of traders, from short-term to long-term traders. Scalpers, for example, are short-term traders who aim to profit from quick market movements. They enter and exit trades within minutes, seizing opportunities as they arise. Scalpers are like the speed racers of the trading world, zooming through M1 or M5 timeframes. They keep their eyes peeled for rapid price changes and jump in and out of trades with lightning-fast precision. Day traders, on the other hand, focus on trading with a single session, typically lasting a few hours. They're like the marathon runners of the trading world, strategizing their trades in the H1 or H4 timeframes. Day traders analyze price patterns and market trends throughout the day to identify potential entry and exit points, making most of the intraday price movements. Next, we have position traders who position their horizon, holding trades for weeks to months. They patiently wait for larger market moves, utilizing fundamental analysis and technical indicators to make informed decisions. Lastly, we have investors, the long-term players, often combining fundamental analysis and technical insight. Investors take positions that can last for months, years, or even longer. They align their trades with their long-term market outlook and have a more patient approach, similar to holding stocks in a portfolio. Among long-term investors in the Forex market, we often find banks and financial institutions playing a significant role. Banks have the resources and expertise to analyze market trends, economic indicators, and global events that impact currencies. They take positions based on their long-term market outlook and manage their portfolio accordingly. With their extensive networks and access to valuable information, banks are able to make informed decisions and navigate the Forex market with a long-term perspective. They play a vital role in providing liquidity and stability to the market. So, when we talk about long-term investors, banks are certainly at the forefront. However, it's important to note that other institutional investors and even individual traders with a long-term approach can also fall into this category. When we talk about financial institutions in the Forex market, we are referring to a wide range of organizations that participate in currency trading. Some of the prominent financial institutions include commercial banks, banks such as JP Morgan Chase, Citigroup, and HSBC, investment banks. Institutions like Goldman Sachs, Morgan Stanley, and Barclays provide investment and advisory services to clients, including currency trading. They analyze the market trends, economic data, and geopolitical factors to guide their trading strategies. Hedge funds, central banks such as the Federal Reserve, European Central Bank, Bank of England, and Bank of Japan. Pension funds and asset management companies. Large pension funds and asset management companies like BlackRock, Vanguard, and State Street Global Advisors may allocate a portion of their portfolio to Forex trading to diversify their investments and achieve long-term growth. Number 6. Insurance companies. Insurance companies with investment arms such as Allianz, AXA, and Prudential may participate in Forex trading to generate returns and manage currency risk associated with their operations. It's important to note that the Forex market is vast and includes various other financial institutions, each with its own strategies, objectives, and expertise in the currency trading. So, depending on your trade duration and approach, you might fall into the category of a scalper, a swing trader, a position trader, or an investor. It's important to align your trading style with your goals and preferences. Now, you may have noticed the abbreviation M, D, and H in the reference to time frames. Let's dive into what they mean. M stands for minutes, representing the smaller time frames in trading. For example, M1 refers to 1 minute chart, where each candlestick or bar represents 1 minute of price movement. It's like watching a time-lapse video of the market's rapid fluctuations. D stands for days, representing the longer time frames. D1 corresponds to the daily chart, where each candlestick or bar reflects 1 day's worth of price data. It provides a broader perspective on price trends and allows traders to capture the overall market direction. H stands for hours, capturing the time frames between minutes and days. For instance, H1 represents a 1-hour chart, where each candlestick or bar covers 1 hour of price action. It's like zooming in on a specific time segment to analyze shorter-term trends and potential trading opportunities. W stands for weeks, capturing a broader view of the market. The W1 chart represents the weekly time frame, where each candlestick or bar signifies a week's worth of price data. MN, on the other hand, represents months. The MN chart represents the monthly time frame, with each candlestick or bar reflecting a month's worth of price action. It allows traders to assess long-term trades and make informed decisions based on a bigger picture view. Remember, the choice of time frame depends on your trading strategy goals and the level of detail you seek. It's like having different lenses to examine the market's behaviors. So, experiment with different time frames and find the ones that resonate with your trading style and objectives. Now that you have a better understanding of technical versus fundamental analysis, trade durations, go forth and conquer the market with confidence. If you found this video enlightening and valuable, please show your support by hitting the like button. Remember, every like brings us one step closer to reaching more traders like you. Don't forget to share this video with fellow traders or anyone who may benefit this information. And if you haven't done so already, subscribe to our channel. By subscribing, you'll not only join a community of passionate traders, but you'll also ensure that our latest videos land directly in your feed. Now, we've got a very special treat in store for you. Part 4 of our free Forex series is in the works. And believe us when we say, it's not something you want to miss. So, stay tuned, stay curious, and keep those trading spirits high.